Oh man, FOMC day. Are you not entertained? It is the first FOMC meeting of the year and the most important one we have had since this tightening cycle has finished. It's the first time that realistically no basis point increase is actually on the table. Now, nobody expects that to happen. The vast majority, this is the first time we've seen it, that 99+% of the market seems to think they have this on the money. We're going to see 25 base points. Literally everybody from specialists to investment bankers to VC funds to institutional funds to everybody you speak to has said 25 base points. They're all focused on the press conference. We get the release in 10 minutes for the interest rate decision, which is broadly expected to be that 25 basis point rate hike. Then after 25-30 minutes, we get Jerome Powell press conference, which is where we're going to focus on the wording that is used. There's a few interesting nuances which I have to share with you. I'm going to break down the expectations. We're going to look at the charts. We're going to cover it off live as well. Smash up likes. Don't forget to subscribe if you appreciate this coverage, guys. And let's see who we got in here before jumping on into the charts. So Reckless Danny, good to see you. Tom, good to see you. Gustavo, yes, check me out, guys. I'm like Mr. Producer Mini over here. Got my different angles. I can see you guys over there, and I can see you guys straight up here. What we're going to do, we got the charts action going on here. I'm going to have it all split up for you so you can see the S&P, you can see Bitcoin, and when necessary, we'll bring in the good old television and you guys can let me know. Let's just do a quick sound check to make sure you guys can all hear this perfectly.
To push back against
do let me know in the comments if you could hear that. I'm just going to pause it now. Cool, so we got all that set up. Let me know if there's any issues with that. And I'm going to bring you on to what is expected. We've got literally 9 minutes for me to quickly run through everything that's expected. So broadly speaking, the market is sitting here expecting an increase to 4.5 to 4 3/4, okay? That's what's expected. I've never seen it like this. It's always been a little bit nervy. So basically what the market is saying is, we're going to get 25 basis points, and we're probably going to get another 25 basis points in the March meeting. You can see that priced in as well, and then maybe a pause at the one after. And then Jerome Powell can come back in the back end of the year and maybe start cutting. That's pretty much what the market's expecting. Now, there's a few interesting things we have to look at because we've just had a few pieces of data come in. And the first one was the job opening. So please, guys, do not overlook this stuff. I know it can get a little bit boring sometimes. We just want to know when up, when rocket, when down, but we need to study this stuff. The job openings figure came in really hot. Okay, so more jobs are still being created. The labor market is still hot. Remember, this gives Jerome Powell a little bit of runway to rug pull us a little bit and to do more instead of pausing. This is not forcing his hand to pause. So this data is not in line with the image that, oh, you're wrecking the economy. I mean, you've just had more jobs than forecast and more than the previous period. Okay, then let's switch over to the ADP, which is the private jobs figure, which also comes out, which came out today. That came in at 106,000. Okay, so we had that 106,000 versus the expected, which was in the area of 190,000. Okay, so huge beat to the downside, showing that the jobs growth did indeed slow. Now, when you look in the detail of the report, I've done all this for you guys. You don't have to trawl for all these PDFs. Just smash the like for me. I'm going to tell you exactly what it says. 7.3% was the increase in annual pay. Remember, I said the markets are going to shift from being focused on CPI to actually starting to look at the details around wages in the labor market. So they're focused more on this stuff. And it was up 7.3%, which looks worrying. But if you actually look at it, it actually paused, right? So the pay growth for job stay is held at 7.3%. So yes, it's still high, just like we know inflation is still high, but we're looking at the rate of change. And that's what we're focused on right now. So that's the data we've had. We'll be looking to see what is said at the meeting. I'll make sure I pull that up from here for you guys. Another thing I just wanted to make sure is this was the summary of economic projections we got in December. Okay, so very important I quickly run you through this because Jerome Powell might just point to this because everyone's expecting 25 base points. And we're going to come on to what the edge cases could be. There's a 1% chance we probably get, a crazy rug pull and have 50 base points. That would destroy markets, guys. 0%, and the market is going to go absolutely euphoric. I think if we get the 25 base points, you're going to be very disappointed with what we see. You're just going to see traders trying to take profits and move the market a little bit. Not much is going to happen. Remember, 25 base points is unlikely to move the market because it's already priced in. That's what I'm trying to show you. What is not priced in is Jerome Powell being dovish. If he comes out and is dovish, which I don't expect, by the way, I think he's going to come out quite hawkish, but I don't think he's going to come out too hawkish. I think he'd probably try to take because he kind of has to admit that progress has been made. He can't just sit there going, oh no, it's horrible. Like, we're not stupid. We know that progress is being made. So maybe he can give us a little bit of that. Let us have those small wins, but say there's still plenty to do. We're still hovering on the edge of a potential recession with forecasted change in GDP for 2023. We're sticking to our 0.5% rate. We need unemployment to still head towards 5%. We still want to head to between 5 and 5.25 for our Fed funds rate, which means we still have a couple of increases left. So these are the things people are expecting him to see to keep his foot firmly on the market. Let's see what you guys are saying over in the chat. 5 minutes before we get the anticipated release. Zed Canton, good to see you here, mate. Stu, mate, good to see you. Uptown Doug, Shane from Australia, Mike, good to see you, buddy. Ian, as always, you legend. Steve, Halim, good to see you as always, buddy. Guys, make sure you smash up the likes if you appreciate this type of content. It takes a lot of research to get this out for you guys, so just smash up the likes and I'll keep doing the hard work for you. Few other things. I don't want you guys to think this is the be all and end all today. Yes, it's important. Tomorrow you got some important earnings. Okay, the likes of Microsoft, Amazon, Google, all producing big numbers. It's like 11% of the Nasdaq tomorrow producing earnings. So listen out for that. Also on Friday, we'll be covering this off together, which is your non-farm payrolls. Remember, this is the labor market figure. The market will move on this, okay? And this is what markets are expecting to come in at 185,000 new jobs created versus the 223 in the previous month. You want to see this labor market start to cool down. Jerome Powell's spoken about this a lot, where he wants one job for every one employee in the market to create that equilibrium and cool the market down. Cool. I think we pretty much got everything we need now leading up to Jerome Powell. Let's head on over to Bloomberg and see what they're saying over there.
And make it a much more difficult picture for the Fed to cleanly read.
Great question, and one that we're thinking about. You know, the reopening, typically when China reopens and puts a lot of support, it spills out into the global economy, both through activity and commodity.
Oh, guys, I've got some more things to share with you. What I need to share with you is the chart patterns, because then we're not going to get a chance afterwards. Look at the chart pattern that Bitcoin's in. It's in this channel, right? And it's just doing quite well. I thought leading up to the FOMC meeting, it might be coming towards the bottom of the channel. It's holding up pretty well. It's basically saying, give me a reason to go towards 24,000. But be very, very careful. If Jerome Powell comes out hawkish, this could happen again. You could get this, which is a fake out and throw straight back to the downside. Be very, very careful if you're not experienced. Taking a look generally across the market, you're seeing altcoins just take a step back, right? Just taking their foot off the gas, waiting for the decision. Those that run faster are cooling off a lot more. Look at Phantom, right? Phantom, exactly like I predicted yesterday. I put out an emergency short, which is why you got to watch the shorts as well, that this was going to cool off. And you saw this. And I even said it could retest the top of this line. Exactly what it's doing. So again, waiting for direction. If you look at this comparatively to where Bitcoin is, Phantom is ahead. Phantom is out of its channel. If this is the channel here, Phantom is out and now retesting the top of the channel. Whereas look at where Bitcoin is. Bitcoin in its pattern is inside its channel. Okay, so you can see that certain altcoins are well ahead of the cycle, but they need to wait for Bitcoin for direction. Really, really important that it waits for direction. Now that we've covered that off, we need to also look at the dollar index, right? Because the dollar index is one of the first things that also moves when you get some news from the Fed, and we need this to continue to stay weak. It's done really well. We've been in a nice downward trend here for quite a while on the dollar index, and we need it to stay that way. We need it to continue to move in this direction. We don't want to give it any excitement that can bring it close to our EMA ribbon or try to flip this and take the trend back. We do not want the dollar index. Bad, bad, bad. Inversely correlated to crypto. We need the dollar to weaken, which means risk rotates on. Cool. Any questions? Shout me in the chat, and I'm going to put Bloomberg on because we are 2 minutes away from the decision.
Are they acting asymmetric out of fear of making mistakes, as have been done by the Bank of Japan as an example in the past? Is there a risk of going one way or the other too much?
I think, they've been saying, and I hope Jepal's asked about this, are the risks still asymmetric?
Guys, a whole bunch of you in the chat. So good to see all you, man. Rennie, good to see you. Me for President, good to see you. Niels, good to see you. Rusty, good to see you again as well. Omar, another familiar face. Reckless Danny, Rich, 80. Curtis, really appreciate you, buddy. Michael, I appreciate you too. Thanks for sharing. Poonam is in India. Awesome. Rich maybe says, I agree. Dovish unlikely, but not priced in. Exactly. The dovish scenario is not being priced in. So that's the opportunity. If he does come across dovish, I don't think he will. I think he's going to be quite firm, but I don't think he's going to be too firm. I don't think he's going to be overboard. I think he's going to keep it quite firm. Right. Let me go make sure we get this, and we'll keep Bloomberg on as well for any updates here.
With Fed Vice Chair Rich, thank you. It's good to catch up as always. We are about a minute away from the Federal Reserve decision, looking for 25 basis points. It seems like the market's been leaning towards that outcome, and it's been widely endorsed by Fed officials, Tom, over the last couple of weeks in the Fed speak leading up to this.
Dissent? I don't get the, this is a time where I'm like, nah, this is not the place to
I'm more interested as the meetings go by, Thomas, whether we start to see that.
Yeah.
I think it's about that time.
And let me make clear, the British do this much better than we do.
They actually dissent.
I think the heritage of this from Greenspan is not constructive.
Do you think the dissent is more likely that people wanted 50 basis points or that people wanted to remove language that was more aggressive?
No, I clearly think there is a range for the terminal rate. And you see that implied by the projections in the summary of economic projections. As we get closer to that terminal rate, you're going to see some dissent. Some people want to go further. Other people are going to want to pause.
We're getting closer to that, though this time around, it is going to be in the nuance that's going to be most important.
The Fed decision, just moments away. Let's get some price action for you going into that Fed decision. Equities look a little something like this on the S&P 500. We are negative 0.4% on the Nasdaq. We're down a little more than 0.1% That Fed decision.
There you go, 25 basis points, guys.
Any moment now.
25 basis points confirmed. You can see it here on my screen. 4.5 to 4 3/4, which is what we're expecting. We got the 25 basis points, but I want to show you the wording. Look at this. The committee anticipates that ongoing increases. Now, there was a lot of debate around this. Would we see increases or increase? Because people are expecting just one more than a pause. Now, I heard from some previous Fed officials that used to be on the board that used to write these, and they said they're just going to leave increases anyway to make it not obvious. It gives them some wriggle room. So that's important as well for us to know, but they have put increases. It's bullish. Let's see how markets are responding. And you're seeing, look, guys, you're not going to get crazy moves in my opinion. Look at this. Spider, look at the SPY selling off there. Bitcoin trying to move. This is interesting. Let's see how this plays out. They're decoupling. They're going in different directions right now here for now. Let it settle down. This is traders doing their crazy stuff. And then we'll see what happens here. Watch that play out. You can see Bitcoin trying to move to the upside here on the 5-minute chart. Look at that. Bitcoin's spiking up again. And now the S&P is turning green. Very interesting.
Over time. In determining the extent of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, Lisa. As described in its previously announced plans, the committee is strongly committed to returning inflation to its 2% objective.
I would say that this is a Fed holding close to its vest, but I think you pinpointed the key phrase. They repeated that further rate hikes would be appropriate, and that seems to be what markets are responding to.
Let's pick up on the price action just briefly. Your equity market is lower by 0.5% on the S&P. On the Nasdaq 100, we are down by 1/3%. Looking into the bond market briefly, we are higher at the front end by about 3 basis points. So that ongoing increases phrase sticks in a statement. We'll catch up with Mike McKee in just a moment on that. Your 2-year at the moment is 4.
It's good news, guys. Look, at the end of the day, we're making real good progress here. I know that outside of all this trading action and stuff, like, we're making really good progress. Let's give ourselves a pat on the back. We are actually maneuvering a soft landing. And this is what's insane about it. Now, it's obviously for today, we're going to have to listen to Jerome Powell's conference in the next 25 minutes or so. We'll be covering that off. We'll be watching the whole thing, all the Q&A. And we need to listen to see if it's hawkish. But, like, if we look at it, at one point last year, we were really up against it. And this is what people don't understand. You guys, there's certain people out there who have been sitting there, or they're listening to certain influencers who are telling them, don't worry, this market is coming straight back down. And the reality with any price action, it can. But when you're sitting there on the sidelines and the macroeconomics, the fundamentals are shifting, the reason that we fell was because of this monetary policy. Because inflation was out of hand and we knew Jerome Powell had to start tightening monetary policy, stop printing, right? So suddenly when you start to see those things improve, you may not like it. You may think that the economy is still in a bit of trouble, but we're actually making progress, right? Inflation is starting to trend down, whether you like it or not. You've got to look at it and say, look, this is where we were. You ran up all the way to 9. It's coming down. Yes, it's not the same as here, but that's largely due to base effects because you're measuring the year-on-year change, okay? So you need to understand that. We can't get too emotional and say, oh, it's just going to come down every time because you end up missing stuff in the market. As you can see, Bitcoin just battling there. Let's get the Bitcoin back instead of Phantom for a second. Bitcoin, look at that, guys. Look at this. This is the traders. This is what traders do, guys. This is what traders do. S&P is still red. I told you, the 25 basis points is already priced in. Now they're thinking about how hawkish Jerome Powell is going to be in his press conference.
along with announcements by the largest employer in the country this month, that we'd see an increase in entry-level wages from $12 to $14 per hour. And that is something that the Fed does not want to see. They're not only worried about setting too high of a floor under inflation.
She's waffling. Let's switch her off. Right. So let's see what you guys are saying. Lefty, 280 people. Nice. Yes, appreciate you guys. Smash up likes. There's a bunch of you in here who haven't smashed up the likes. All I ask, if the stream deteriorates or Jerome Powell annoys you, just unlike it at the end, innit? I'll take the blame for it. It's fine. Possible short hedge if Bitcoin hits recent highs before Powell's press conference. Phantom passed 52 cents. Yes, indeed it did. Shoaib says manipulation, bullish. Ian says, if we pull off this soft landing, Powell needs a Nobel Peace Prize. Interesting point you make there. And I've actually been kind of thinking about this recently. It's like, is this a good thing? I've been trying to sit there and think. I know it sounds crazy, but is a soft landing a good thing? If you think about it, just zoom out. I know, forget our bags for a second, forget our portfolios, just very long-term thinking. Recessions are created to create boom and bust cycles, right? And when you have a recession, it gets rid, just like in Bitcoin, it gets rid of the weak hands, right? It gets to the people who have been running rubbish businesses. It creates strength in your economy so that you can go into your next bull run. It capitulates the weak. It flushes out the system and all the greed and all the bad practices. And that's needed in a normal economy. So if we avoid that, if we did this unprecedented amount of printing throughout the pandemic and then manage a soft landing through the work of the Fed and Jerome Powell, like, yes, it'll be good because we've managed it, but then does it mean we're going to have a bigger recession waiting for us when it eventually comes? Are we just kicking the can down the road? So that's a little bit of thing. That's something I've been thinking about as well. Like, is it necessarily a good thing? Like, recessions are healthy. They're part of flushing out the system, and it gives people opportunities to buy low, to build their, buy real estate. And if you never get that opportunity, it just means that you're going straight into your next cycle with all the same bad practices, because loads of people haven't suffered any austerity. People are still spending. They are chilling. Right? People are still going out on their holidays, on their hotels, buying their fancy cars. They're not feeling it that much just yet because you're not in a deep, deep recession. And that's an interesting take. Brad says Dixie going up fast. Let's take a quick look at the dollar index then. We drop it down to the 5 minutes. Yes, it is climbing. Very interesting. Very interesting that the dollar index is climbing. I'm guessing the market's going a little bit risk off leading up to Jerome Powell's press conference. That's very interesting indeed. I wouldn't expect that, but again, the market had priced in 25 basis points, so I don't expect, some crazy rally right now. I made that very clear when we started. Like, the market, you can see we're barely moving. Bitcoin down 0.47%, S&P barely moving as well. Like, it was priced in. It was the first time I've ever seen 99.9% surety that we're going to get 25 basis points. Right? Now, that would be catastrophic if Powell played a cheeky one and did 50 basis points. Wow, he would have really put the nail in the coffin. But Powell's in a very tricky position. He's in a very, very tricky position. If he goes too hard, he can drive us into a recession. If he goes too soft, inflation will come back. He's got to steer this market without giving them the applause. He can't celebrate. He can't say, oh, we've done it. We've cracked the back of inflation. He's got to keep going. He's got to say, oh, there's still more to go. There's more work to go. He's got to do all of this. But slowly, he's got to start becoming our friend. And now we can look towards March and say, okay, if we get another 25 basis points, and then we're going to pause. Like, we'll be at the upper, we'll be at 4.75 to 5. And then we can pause. Nice, right? The markets will be happy. Trying to get a good 5-minute candle here on Bitcoin now. Let's see what you guys are saying in the chat. Don't forget to smash up the likes, people. Still need some more likes from you guys. Let me know if there's anything else you need covering here, because I'm fake Mr. Producer. I can pull up different things here if you guys want to cover off something else. But again, this now brings our Fed funds rate to 4.5 to 4.75, which incidentally is the highest level since October 2017. Yes, this is the tightest monetary policy has been for almost 6 years. Impressive. Don't forget, tomorrow, bunch of earnings. Microsoft, Amazon, those guys. Then on Friday, non-farm payrolls. Really important, that non-farm payroll figure. So, doesn't mean we're out of the woods now because we've got 25 basis points. And in fact, when Jerome Powell speaks, do not be surprised to see him throw us to the downside. He's got a habit of doing that when he speaks. It's just like, we just need to get through this press conference and then move on. Steve says, at the end, are we just moving the problem forward? Yeah, exactly. That's my thought in the back of my mind. Like, if we manage to avoid this recession, but because of our greed, like, every action is an equal and opposite reaction, right? If you've been greedy and you've printed loads of money and to get through a situation, then shouldn't there be the consequence on the other side? Right? If you ate that burger, shouldn't you go for that jog? Like, it's that kind of yin and yang balance. Like, what happens? You're just kicking the can down the wrong. It's not, you may think you're a genius and you've navigated this soft landing, but the underlying issues will be somewhere. I mean, if we take it on a very micro level, I know it sounds horrible because there's people's livelihoods and stuff, but if you take a company that was badly run, let's say like a Celsius, and you didn't have a recessionary period, they could fluke it. And there'll be companies out there right now that if we did go into a recession, right, a deep one, like a 2008, 2009 style recession, or even just a normal recession, they wouldn't make it. They would have been flushed out of the system, and we would have went into our next bull run with healthier, stronger companies, because it gives stronger people a chance to start who are going to ride the curve in a better way. So I know it sounds very capitalistic, but that's what happens in bull and bust cycles. Do you think LDO will do well after ETH staking or unstaking or upgrade? It's going to be an odd one. I'm not sure what's going to happen. I feel like it's going to be a bit of yin and yang, right, with the whole ETH situation, because yes, people will be able to unstake after Shanghai, and there's going to naturally be an element of people who want to sell that haven't been able to access their ETH for ages. But then at the same time, there's going to be new people who want to go and stake their ETH now that it's flexible. So yeah, it'll be interesting to see what happens. If employment rate stabilizes, best case scenario, yeah, we just need employment. It's that employment bit that's the final bit. And again, don't be surprised to see Jerome Powell say we've got plenty of work to do on employment, because the market already feels like we've got inflation. So if Jerome Powell keeps saying we need to bring inflation down, he's gonna be like, yeah, it's high, we still got work to do, but market feels like we've got over the back of that, and we can see rent and shelters and wages starting to come down, and that should bring down the final bit of inflation. That's why market's so happy. The jobs market, however, is where there needs to be some work. Look at the jobs figure, which we just covered off. 11 million versus 10.25 million. You can't say that this is parity just yet. So Jerome Powell can use this. It's lucky that this came out today. Jerome Powell can use this as something to lean on. Say, look, the labor market's still hot. That's one of my remits, and I need to bring this in line. That's not okay. Punav says, should I buy Phantom now? Good question. Should you buy anything now? I mean, take a look at Phantom as an example and switch it up to the hourly, because never make irrational decisions on short time frames. But you always want to be buying in positions of strength, right? If you're looking to buy, you want to be buying position of strength. If you're looking at this on a short-term basis, where was the position of strength? The position of strength was this buy here, which is exactly where I bought earlier today, right? So I am buying here on the dip. I said yesterday when this was ripping, wait for the retest, and then you buy here. And now you try to trade it up. Whether it reaches the top or not, you don't know. But at least you're now in the green and you can trim your profits as you get. So if you get past this peak here, trim profits. In terms of your long-term portfolio, then look at it from a different point of view. Right? Then you want to look at it from this kind of point of view, the daily chart, bring out your EMA ribbon and say, look, we are super overextended right now. So longer term, do not be surprised to see Phantom at some point correct down a little bit, because what we're seeing now is not a correction. It's a correction of the 5-minute chart, granted, but on the daily chart, it's not a correction. So at some point, will it come down to 41, 39, these levels? That's where I'll be looking to load for my long-term bag a little bit more. Now, maybe Jerome Powell will give you that. I don't think he's going to give us that much of a dramatic fall. If you look at that fall there down towards your EMA ribbon, you're talking about a 22% fall. I don't see it happening. It's something that could happen over a long period of time, but it's not going to be something that just happens in a day, 20% down. I have to be quite painful a day for that to happen here on Phantom. But maybe over a couple of days, Phantom can start moving sideways and start trending a little bit down and give us some opportunities to buy the dip. And similarly for Bitcoin, right? Wait for it to come to you. Let it come to 22K if you want to top up. But even in periods of consolidation, if you want to nibble a little bit. Right? Sometimes I do that. If I've got FOMO and I can see it consolidating in a pattern like this, getting ready to explode, I'm like, I just need a little bit more. I'll nibble, but I'll try and nibble in my favor again at the bottom of the channels. So even when you're doing that, do it in your favor. That's always important. Guys, we are 15 minutes away from the press conference. Looking forward to it. Smash up the likes. Do let me know if you have any questions. If you have any altcoins you want to look at, drop them in the chat. If I miss your chat, just throw a super chat or something if you want me to do TA on any of these coins. I'm happy to do TA on your favorite coins. Ian says, you buy the ticket, you take the ride. A lack of consequences can make them think that they can do this whenever. Yes. And look, I don't want to be the bearer of doom and gloom, but we've got to think about these things, right? Yes, we can get out of this and do a soft landing, but we're constantly going to be kind of worried. Where's this big pothole going to come? Is it going to be in 2024? Is it going to be 2025? Because we've just not had our normal reset. Reckless says, give a like, everyone. Great. Appreciate you, buddy. They're very kind of you. Cadena Britain, good to see you. Hope you enjoyed the Cadena video earlier today. For those of you who haven't seen it, go watch it. I tricked a bunch of people because I said, is Aptos a Cadena killer? And obviously, there's a bunch of thumbnail investors out there who just invest on thumbnail, apparently. So apparently, they just open YouTube, read a bunch of thumbnails, and then trade on BYBIT. That's what they do. True story. Kanani, worst FOMC ever. Guys, look, we can't hate the FOMC. They're actually doing a good job. It's a phenomenal job, in fact. Like, I'll be the first to hate on them if they do a bad job, but this is literally a phenomenal job. Like, how have they managed to thread the needle right now? It's impressive. From here, we were there, Jan 21, 1.4%, right? Boom, all the way up to 9%. Came down, and then they've slowly managed to eke away at it. Now, there are risks. I don't want you guys to just think, oh, we're out of the gates, it's so good now. No. What are those risks? The risks are that inflation is still persistent. What if this inflation rises back like a phoenix and says, nah, of that 6.5% headline, what if there's like 5% or 4.5%, which is just entrenched, it just won't go away. And Jerome Powell's trying his best and it just doesn't go. He's going to have to hike rates again. He's going to have to stop his pause and start going again. 50 basis points, 75 basis points, back into that game again. Not ideal, will drive us into a recession, and it'll be painful. So these are the risk factors we have to be aware of. I don't want everybody to think moon, 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 moon. It's a bit more complicated than that. JH, good to see you, buddy, again. I think the problem is the general population don't know how harsh the region will be. So used to something for nothing and an easy life means rates need to drive real pain to stop spending. Absolutely right. And you know what? I can't blame the new generation. Think about it. I was so lucky that when I started in investment banking, I've got a video coming out on this over the weekend, but when I started in investment banking as a trader, I did so in that 2008-2009 period. So I got a big reality check. I saw redundancies, I saw tears, I saw managing directors losing their job overnight. Like, I saw pain. So I came in seeing that. But imagine you came in as a trader, as an investor in 2020 when the government was printing. You're thinking, this is an absolute laugh. I look to my left, I see Tesla rocketing. I look to my right, I see Bitcoin rocketing. I see every altcoin rocketing. I see Terra Luna, people printing 20% for fun. Right? What's good? Like, it would be insane. You look at GameStop, you look at all these things. Like, what a crazy time to have entered investing. And this is one of the inspirations behind building this channel. Like, I just looked at it and looked at the creators out there who were not looking at this kind of stuff, who are not streaming this today. They've only started streaming this because they see people like me starting to stream it. That's why they're now covering it, because they know they have to cover it. They were not trying to cover this stuff before. Go back a couple of years. They weren't covering FOMC. They didn't know what inflation was. They couldn't tell you the difference between core and headline inflation. But now they're starting to cotton on. And these things are important because we are in a tightening cycle. But these things are perfectly normal. And the sooner people realize that these peaks and troughs are good and provide opportunities, you'll become a better investor. That's all Warren Buffett does. Wait for his time, right? Just wait for the right time, enters and exits and enters and exits. Lefty, can we do some TA on target prices looking at Link, Phantom, Coty? Yes, we can take a look at them in a sec. Dave wants TA on Cadena, Matic. Abdul Latif says impossible to see Bitcoin coming down more than 22,500. When people think things are impossible, that tends to be when it happens. Linde says was a good video on Cadena. Keep it up. Appreciate you, buddy. Which is more likely first, Bitcoin at 30k or Gina makes appearance at the next? Yeah, I don't know. Vicky, I'm late to the party, but it looks like it's a good cap from the FOMC for crypto. Thanks for stream, Ijaz. Appreciate you, Vicky. Yes, 25 basis points. You know, no surprise. Everybody's expecting it. Whoopie-doo, right? Let me just tweet out that we've got our 25 basis points, and now we look to the Fed meeting. Cool, that's done. Right, let's do some TA with you folks. And let's pop the TV off. Remind me in 10 minutes we need to bring Jerome Powell back onto the screen. Right, so let's start off with Matic. Once you've asked for Matic, and key level here, $1.04, right? Nice. If it comes down to $1.04, which is testing all these levels here, I'll be happy to load up a little bit more. Even at this level, I don't mind nibbling that. That's not chasing green candles. That's an okay level to be nibbling at. On the daily chart is where you start to look at things a little bit more interestingly. which is where will we come down to that 104 level, right? That's where the EMA ribbon is. That would be a lovely buy in this range. Anywhere from 101 to 104, I'd ideally love to get there. If we don't get there, I'm happy to nibble around here as well, just in case we don't come back down. Good project, one which I continue to DCA in. It's pretty straightforward here on Matic. Weekly chart, this is the bit I want to show you guys. And on the weekly chart, you can see very clearly the Fibonacci, well, no, you can't with my messy chart, but Fibonacci ratio 0.618 to 0.65 level looks at a $2 Matic. So for me, comfortably, like if I was Matic, I'd be very disappointed if I was the Matic team that you couldn't get back to here, let alone your all-time highs at $3. So still comfortable, double of your money just to get to the Fibonacci ratio, triple your money to get back to all-time highs. And then obviously the Fibonacci extension takes you to $4.50. So crazy on Matic opportunities here just to get to what I think are conservative levels. If the Ethereum ecosystem continues to grow, I don't see Matic going anywhere. They're the best layer 2. I see layer 2s being a good narrative this year as well. If you've not watched my layer 2 video, make sure you go watch that. I talk about optimism, I talk about Matic, I talk about various others as well, Loopring. Go check that out. Very important. Phantom. Let's talk Phantom. Phantom, you guys know where we're at. It's absolutely smashing it right now, but do not be surprised to see a little bit of a calling off, right? So again, we're on our journey. The first retracement level is getting up to that $1.50 mark, and we did fall quickly, right? Again, so do not be surprised to see if this falls quickly, because we did fall quickly. The bears failed to create any scaffolding to the downside, therefore the bulls can take advantage of that to the top side, okay? So you're looking at there. Then if you look at their golden ratio, $2.34 to $2.45, still a crazy almost like 5x on your money just to get back to here. If you're getting to all-time highs, then you're looking at more of a 7x on your money, which is interesting. And obviously the Fibonacci extension gives you more of an 11x on your money up at $5.80, which again, I think is very conservative. Phantom, one of the most undervalued layer 1 solutions in my opinion. I've made a bunch of videos on them. Definitely go watch it and make your own mind up on if you think it's a good play. VPVR to look at as well. And you can see we're at that highly traded level here on the weekly chart, but we're starting to break through it and get to less difficult levels. Then it gets difficult again once we fill this gap, right? Once you get to here, which is around $1.14, you'll see things get a little bit more difficult. But do not be surprised that if the wider markets are doing well, Phantom can fill this gap quite quickly. You've seen it's been like a rearing horse ready to go. As soon as the market gives it permission, it's just gonna jolt. People are starting to find out about it, and you're seeing the price start to move there on Phantom. I think what was some of the other ones you guys said? You said Cadena. Again, made a video earlier on Cadena. A bunch of key levels here which we need to watch for. Let's drop it down to the 4-hourly here. And you can see we're at an important support level. Look at that dotted green line I just put on there. That's where we are. We created this W pattern. We broke to the upside. Got rejected from this area, right? Just like we got rejected from here. And now we've come to retest the neckline. Similar to what Phantom was doing. Phantom broke out, came to retest the neckline. Now you want to see, do the bulls on Cadena have strength to push it through $1.44? It can't just go there and show weakness. Like, what I don't want to see is this. That's a nightmare, okay? What you need to see is this needs to push with vengeance, get above here, retest, and keep going here on Cadena. Again, longer term, I want to see more progress from this project. Honestly, they need to have a big 2023. Otherwise, I'm going to be disappointed with them. Cool. What else did you guys shout out? Do shout out different tokens if there are any others. Can we get a veracity chart? You can. I don't think it's one I look at too often, to be honest. Let's see if I have it open here. Let's put it up. Let's look at veracity. Wow, what an insane chart. I can see why you wanted to pull that up. Wow, 133% in that week. That is impressive. You know what to expect from this, guys. Like, just expect a calling off. I mean, look at it. That is insane. Coming down to its daily EMA ribbon. Holding up all right, actually, there. Although I wouldn't be surprised to see it really come into it and test it further down here. What was the catalyst for this? And give me the comment, Lil Ray 21. What was the catalyst for this? Not too familiar, but from a TA perspective, like, it's broken the pattern, right? The resistance it's facing is this bit here. So this is a hard level up to 0.007 is the challenge. 0.0075, sorry, is the challenge. Okay, so 75. It's on 70. It hit 73. And now it cooled down, back down to 59. So that's where the challenge was. It's up here at that 75 level. Check out the KuCoin chart. Okay, let's do that. Maybe the chart was not. Guys, we've got 7 minutes. Smash up likes, Jerome Powell conference, and he's going to be dry. I'm warning you, but we have to listen to it. We do have to listen to it. Oh, I did have it open. That's interesting. Ah, so I was looking at this coin ages ago. I remember now. Okay, cool. So that's had a crazy period, just like some other altcoins has. Let's just take the swing low. Let's take a look at the Fibonacci ratio very crudely here. I want to take that swing low. I want to pop that at the swing high up here. It's been to 8 cents, and you're looking at the golden ratio between 5 and 5.7 cents there. Okay, so that's the level I'd be looking at as a retracement. The first level of resistance will be at 3.4 cents here at the 0.382 mark. Cool. Any other tokens anybody wants to look at? Talk about Chainlink. Yes, let's talk about Chainlink. Chainlink I like. Another one which people don't want to talk about until it runs for some reason, but definitely want to take a look at Chainlink. It's a staple in my portfolio, one I remind myself to continue dollar cost average. And again, swing low to swing high brings you comfortably to this level, 34 to 36. So for me, I keep in my head $35 on Chainlink. The team will be very disappointed if they don't get that. I mean, that's a 5x on your money here on what I call a blue chip. Getting to all-time highs brings you to 52, and then your Fibonacci extension brings you to 82. Okay, so crazy. I mean, this is what I'm saying. Like, lots of people want to focus on crazy, like, low-cap gems. I get it. But when you've got serious wealth or you're putting some serious money into the markets, then you've got to be a little bit more careful. Now, if I had very low amounts of capital, then of course you play a little bit riskier, but if you keep playing it too risky, you'll never build a decent amount of capital. And this is the thing. A lot of people think, oh, I've only got $1,000, and they risk 10 $1,000. That's 10 grand, right? And if you play moderate risk with 10 grand, you'll get to 100 grand. You will. But if you keep treating the mindset like, I've only got a little bit, your grand is always going to lose. You're like, oh, I've only got $1,000, I've got to go for a risky go for another risky one. Okay? So that's what I'm looking at here on Chainlink. Let's drop it down a little bit here on the time frame. And you can see if we bring up the EMA ribbon. Let me just pop this off. We've lost our 4-hourly EMA ribbon, but on the daily, decent time, right? It's come to its EMA ribbon. Not a bad time. Not a bad time. You're definitely not chasing green candlesticks here if you were to nibble on that. Maybe I'll do a little bit more nibbling on this as well now that it's come and hit its EMA ribbon. Let's also take a look at Coty. Again, no surprises on having a little bit of a run-up with Coty, although Coty hasn't really done so well after the JED token, which is interesting. Again, buy the rumor, sell the news. It took the run-up here, and by the time JED and Shen token were launched, it just gave it up to the downside, okay? So don't be surprised. If you're looking to add, wait for the EMA ribbon. These are much better times to be adding than here. Look at that. It ran up to 12.8 cents there, and you could be buying now at 9.6. Big difference, right? It's a big difference. It's dropped a quarter. And that's how you start doing your DCAing. You don't chase it, you let it come to you, and you add. Again, this is a tiny market cap project, so I won't go crazy on that. You lot are spamming with different tokens. I can't keep up with you lot. Right, what have I missed? Yeah, DY by DX went crazy, right? And again, another narrative I spoke about in my videos. Like, do not be surprised to see these decentralized exchanges do really well. What do we learn from Celsius? What do we learn from all of these failures? Like, that people want decentralization. We can't trust centralized plays. Absolute tear here. I mean, yesterday alone was 30%. Crazy, crazy, crazy move here. And again, most things are now forming similar patterns, right? It's just the magnitude of the pattern that's different. So Phantom, DY by DX, they're moving a little bit faster, and the narratives are starting to play out. And the way I'm bucketing it in my head is quite simple. Do I have layer 1s? Do I have layer 2s? Do I have decentralized plays? That's the way I'm thinking about it, broadly speaking. And that's what the research reports I've been reading from VC funds seem to be covering off, is those plays. Now, I know some people want to go into gaming and NFTs, and maybe I'll miss some moves on those. And it's okay, I can't catch every move. But right now, I'd rather make sure I've got those core pieces of my portfolio right. And when the bull market starts to get underway, there's time from my experience, there's time to get into NFTs and gaming. They tend to come in the latter part of the bull market, but the layer 1s will just, and Bitcoin, Ethereum will just go, and you won't catch them. So it's really important that I eat my vegetables instead of getting caught up with some of these riskier ones. 2 minutes till Jerome Powell, guys. Really enjoyed this session. Maybe we should do this more often. Smash up likes if you do want to see this kind of TA on your favorite coins more often. Let's see if there's another one I can do. Doug says, I seriously don't think you're escaping risk by choosing Chainlink. For me, risk is a spectrum, right? First and foremost, from Bitcoin, it's the safest play. Then Ethereum, you're taking a big jump from Bitcoin to Ethereum in terms of magnitude of risk. And then from Ethereum to anything in the top 10, you're taking another jump of risk. And then from to the top 20, you're taking another jump of risk. So it's all layers of risk. And then you need to take into effect, has a project been through various bull and bear cycles? That gives you a little bit of peace as well, because they've experienced the 85, 90% drawdowns, right? So the coins you're seeing now get through this, which survive Bitcoin at 15,500. Like, you can almost give them a feather in their cap. So the next time we're in a bear market, you go, hang on, I trusted Phantom. Phantom did that, or that project did that, that project did that. And it'll give you a confidence that it can survive that, and they've got good risk management practices. Let's take a look at Algorand as well before Jerome Powell jumps on. Guys, sorry if I missed your tokens, man. We'll try to do this more often. Make sure you jump into the Discord as well. I can put up some screenshots for you guys and do some charting, or hit me on Twitter, and I'll be more than happy to chart up for you guys. That's not an issue at all. Or we can schedule another stream. So Algorand coming to its EMA ribbon here on the daily. Key support, we're well past it at 21 cents, which is good. Can we get a bounce and post a higher high? That's going to be key. 26.4 here on the left-hand side. It's going to be a key level. But it's going to need the wider market. Algorand really needs to have a big year this year. I've said this numerous times, but they really need to do it. They really need to go and deliver. I know they've made a few management changes. You can see here, we're going to switch over to Jerome Powell very quickly, guys. This can get to 170 to 177 on its Fibonacci ratio. So crazy risk to return on these projects, and pretty much a lot of altcoins are like that. Right, I can see the man himself walking across. Can you see him? Let's switch.
Walking in after hiking interest rates 25 basis points. Here's the chairman of the Federal Reserve.
And welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, let's go. Foot firmly on the neck, but let's see the Q&A. This is the interesting bit. Let's see. Hopefully I have some good
Chris
questions.
Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder, and could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil. That's good. You've given us a little bit, because you can't deny that. That's what I said earlier. You have to accept it.
You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently. And I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation.
Keep talking, Jerome.
And
Keep talking, my friend.
you know, quits are still at an elevated level. So by many indicators, the job market is still very strong.
Colby and then Howard. Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
Good point.
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be. And that's obviously back in December. And the median for that was between 5 and 5.25%.
This is going to be important.
At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage, whereas of course we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see. Our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
Bitcoin 0.7%
I guess I
would
would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far.
Nice. This is nice.
Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening. And for the reasons we thought, it's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. But that's really around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same. And, we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent, we'll see more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Happy so far.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
Well, you'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria?
Didn't give us anything there. Good question, though.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we... Say your question
again. Green. What a reverse.
Will the Fed do what Treasury
now
directs as it relates to making payments, or will it do its own analysis of any legal constraints?
My trade is printing, guys.
So you're really asking about
trade.
You're asking about prioritization, in fact.
Yes.
Nailed that one.
I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling. And I gather there are discussions happening, but they don't involve us. We're not involved in those discussions. So
bears are going to eat that.
We're the fiscal agent.
Gina and then Steve.
I'm not paying attention to him. Look at the charts.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. we judged that the appropriate, thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made.
Or see now,
we're going to write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that
Thank you, Powell.
Goods inflation will move up fairly soon, back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector. That's really not driven by
wrap up soon.
labor markets, wages.
Getting a bit of rejection here.
So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment. Your question. I do think there are a number of dimensions through which the labor market can soften, and so far we've got, as I mentioned, in goods we have inflation moving down without the softening in the labor market. I think most forecasters would say that that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael. Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
200 likes. Come on, guys, smash up likes.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit. And that will matter for us, potentially. The labor market remains very, very strong. And that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year, and that's my base case is that there will be positive growth this year.
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months. We've seen 3 months in a row. Governor Walters suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence?
So I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, And we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us?
Man. 199 likes, you do me wrong.
Soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job, and it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will, complete this task because we think it has benefits that will, support economic activity and benefit the public for many, many years.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down. And Congress did what it did, and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon. Thank you, Chair Powell. Simon Rinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession. And we have inflation moving down. Into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Don't see 2023 rate
Scott Horsley from NPR.
That's interesting.
One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
The market's not upset by that.
That's the general sense of it. Look, we understand, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time. But we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health
Bitcoin's stalling,
issue.
but the S&P's gone. Interesting. Dumb question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I wanted to go back to another thing that Fed Vice Chair Lael Brainard said recently. She said she doesn't see signs of a wage price spiral, and I'm wondering if you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, once you see it, you have a serious problem. That means that effectively in people's decision making, inflation has become a really salient issue, and once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this, and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are. We pick that up in conversations, and I've seen some data too that show people are, gradually. They're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low, with 3.5% unemployment and high wage increases nominally by historical standards. Why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even, you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses. Essentially, we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important, and in this case, I would say the risk 8 months ago or so,
15%
longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I mean, I'm not going to try to persuade people to have a different forecast, but our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Last question, guys.
Hi, Chair
Last
Powell.
question.
Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk, the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
All right, we are done. Right, guys, we are done with him. Let's switch this chap off. Let's turn him off. And let's see where we're at with the markets. I will be doing a summary, guys, so smash up the likes on your way out. And I will be doing an 8 to 10 minute summary on what to expect. So make sure you look out for that in about 30 or so minutes. And do watch it and give me a like, even if you know exactly what's going on. As you can see, Bitcoin is consolidating here, but it is struggling a little bit. S&P continued to run, remember. So if you look at it about here, a couple of candlesticks ago, Bitcoin stopped running at 10.2. And you can see here at 10.2, the S&P continued to peak, and now it's kind of cooling off. So be careful with your trades. Just the hype's going to die down now that he stopped. Be very, very careful. But look, progress, right? Progress. Step by step, we are making progress. And that's the good thing, because we've seen that we've now gone from 75 base points, 250 base points, 225. We can see that at some point this year, we're going to get to a pause, and that's good. Now, the only worry we need to be wary of is what if inflation comes back roaring? And that's what we need to be careful of. Jerome Powell has this tricky job now of balancing expectations with markets, of making sure they don't get ahead of themselves so that inflation comes back, because then he'll have to increase his rate hikes again. We don't want that. Nobody wants that. But at the same time, he doesn't want to do a 50 base points today just to finish the job off and drive us into a recession, which wasn't needed. Because remember, each of these interest rate hikes he's put into place takes a lag. So it makes sense what he's saying. It all makes sense. He's trying to thread the needle with this soft landing, and it looks like so far he's managing to do it. Now the naysayers are going to continue to be the naysayers, but the reality is, if we don't enter the market, you're going to regret it. What if we never see 15,500 Bitcoin again? What if we never, like you guys said, see Phantom at 15 cents again? You're talking 55 cents plus. So for your anxiousness to not get in the market and not be data-led, that's holding you back. Right? If you're just following a certain influence saying, no, we're definitely going to go back to 15,500, they give you no evidence, they're not giving you any data, then you're looking at the data in the face of inflation coming down. You're seeing the labor market start to improve. You're seeing the economy hold up pretty decently. And we've started disinflationary process. And Jerome Powell's now even saying it. Right? So this is not just a pump manipulated out of the masses. It's not just a huge, bull trap to the downside. No, it's a move because there's a shift in the market. I've been saying that for the last couple of weeks. This is a real move based on real data. This is not emotion. This is real data. We are shifting out of it. Now, can it come back? Can inflation come back and bite us? Of course it can. But we have to look at the data. We can't just be scared on the sidelines. So I'm going to do a summary, guys. Please smash up the likes on your way out. Thank you so much for spending an hour with me. I missed the United game for this. I'll go see how much of that is left and have a bite to eat. Thank you for joining me. I will do a summary video first, so make sure you look out for that. And I'll see you in